Ladies and gentlemen, welcome back to Friday Night Live.
So many cameras.
Are we here? Are we here? Are we there? Are we there? Are we... Mr. Mark Vittori,
Welcome.
my special guest for this evening. I guess it's just you and I, old cowboys, back at the ranch. Looks like I've got a little bit of green Irish luck behind me today. I mean, I'm wearing green all around. I've got green behind me.
Absolutely.
I love luck of the Irish. Don't you, Mark?
Look, the Irish have done well for this country, and I think we take our hats off to them, that's for sure.
Yeah, and I suppose we do celebrate St. Patrick's Day. I went to a Patrician school as a kid, so Patrick's Day is always big. Luck of the Irish it is. So, kicking off, this night's Friday Night Live, actually tonight, ladies and gentlemen, is going to be a really, really fun episode because we're kicking off something officially known as Investing World or Investment World 101. So officially as episode number 1 of Investment World, we've actually curated a list of questions that we get asked on a daily basis, and we've actually also curated a list of questions that we would like to know from each other so that we can, from the audience's perspective, get a bit of an in-depth view on how we think as investment professionals in the world of investment real estate. So maybe what I might do is, Mark, first of all, how was your week?
Very good. As we know, it's always a cracker. We are talking investments today, so I decided to bring out the old Trumpy tie.
Oh, nice.
And we're all, we're ready to talk very serious things.
Okay, great. Fantastic.
Yourself?
I guess as long as we talk... Yeah, my week was really good. I mean, Friday night, it's about to kick off. I have a feeling for you and I, it'll be not Friday Night Live, it'll be Friday Night Lit. Or at least a version of whatever it is, right? But anyway, Friday night holds what it does. But the week was good. Week was chaotic as always, but chaotic in a really good way this time around. So when I say good way, perfect balance of strategy, perfect balance of execution, perfect balance of a bit of luck too. Hence the Irish luck behind me. So, okay. Well, what investment opportunities that you've missed do you wish you'd have taken advantage of, Mark?
I think that's a really good question because there's so many answers I'd love to give you today, to be honest with you. Can I give you one in particular? Probably. And I'm going to be biased towards real estate right now because this is what we do for a living. But not only just that, we probably love real estate as an investment class more than any. It's not buy more real estate over the last 10 years.
Really?
Yeah, should have bought more, the old saying goes.
Right.
But, we all get caught up in certain fads or certain times in our life where we want to try things. But I think a big one is definitely getting more real estate as number one. And probably if I was to say number two, look, to a degree, I would probably say investing into the stock market more heavily at the start of COVID.
Right. So that you mean that big crash sort of thing in that ultimate dip that we had gone through. Because I know you and I together did take advantage of some awesome opportunities when it came for not the biggest part of the dip. We actually got connected after there was a tiny bit of a recovery, so to speak, in the market. But since then, we've been implementing a strategy that thus far has worked fairly well. And so picking your spots, looking back, you'd have hoped that personally you would have divested a lot more into the crunch time when everyone was sort of running away from the market. You would have wanted to do something where you double down in that instance, where that fear mentality in the marketplace is something that should be capitalized as maybe a greed mentality from an investor side. Is that what you're sort of coining towards?
Absolutely, yeah. I think it's look, it was a very interesting time. No one had ever experienced anything like this. So yeah, in retrospect, we should have looked at it and said, well, we went through certain versions of it back 10 years earlier, 5 years earlier, 20 years, whatever it was, right? But I think because it was on such an enormity, to be honest as well, I actually had my son at that time.
Yeah, you did.
Literally days before the world went into proper lockdown. So,
I know, right?
I was probably lack of sleep, let's just call it that. But, it's one of those things, yeah. If I could look back, I think I would have certainly have parked a sizable amount of liquidity or whatever was available. But, this is the game of investing. You miss some and you get some.
Absolutely. And feel free.
So I was going to actually ask as well, Sean, was what investment advice would you have, or do you think you have heard recently that is applicable?
Wow, recently. Okay. Now, I was watching this really, really interesting video the other day about these guys who are talking about tracking. Very funny. It leans into exactly what you were talking about. Okay, so in the heavy dip, let's say officially the best day to be buying stocks or financial market, sort of investments, is traditionally known as the day where you buy where it's dipped the most, or where the market's bottomed out, and then you sort of ride the way up to the new height of the market, right?
Yep.
Which we did experience actually from COVID from COVID's crash to COVID's resurgence of having the new peaks that stocks ended up hitting, I think, tail end of last year, thereabouts. But this video actually shed light on something very, very interesting, and this is the best advice that I've heard recently. So I've watched this within the last couple of weeks, and it was actually talking about the fact that if you timed the market to perfection every single time, where you bought at the low points and you sold at the high points, and you averaged it out over a long period of time, if you were just an investor that could have invested and would have invested, your returns would not have actually have been that far off the best gaining days. So there were almost 3 or 4 methods spread across this video that I had watched. And the 3 or 4 methods that were spread across this video were perfect market timing, where your results were somewhere here.
Yep.
And then there was just investing when you could have, or on the first day of the year, January 1st, on average over a 10-year period. First day of the year, you just drop cash into the market, and then next year you repeat. Those results were actually here. They weren't actually like all the way down the bottom where, you'd expect, because there's no strategy behind it. But I suppose the strategy is not dollar cost averaging, but the strategy was buying when you could, which turned out to be almost as phenomenally good as buying on the best ever days to buy stocks.
Yes.
And apparently the longer your investment horizon, where you consistently dollar cost averaging ended up being somewhere about here on that chart that I had seen. So I might even find a photo of it so that I can throw it up there for all you guys at Friday Night Live. But the moral of the story is investing when you can, or taking an approach like dollar cost averaging, is so much far better than just trying to be a genius at timing the market and listening to the news. So what came hand in hand with this advice that I learnt, Mark, was that the media and economic analysts have a lot of something called recency bias. I don't know if you've ever heard of it. Producer Ryan shed some light if you've ever heard of something like recency bias. No, not recently? Okay, well, speaking of recency bias, it's like if the market is, over the past 6 months, tended to just be on that upward trajectory, the bias is that it'll continue to do so. And the other thing is accentuating the losses. So if it's on a downward trajectory, saying that, from a media standpoint, that it's just going to get way worse before it gets better. And looking back, the advice that I got was that it's never always the case. If everyone pretends that they know what's happening in the market and so forth, so on, the smartest thing to do as an investor is invest A, when you can, B, dollar cost averaging is not a problem. And we can apply the same thing to investment real estate, because what is investment real estate dollar cost averaging? That pretty much just becomes buying when you can buy investment real estate and deploying it into the marketplace. So long term, the positive effects of it happen over a time horizon. So obviously if you bought stocks at their peak and the next month they crashed, of course in the short term, which is 7 days or 14 days, it'll look like you made a massive loss. But the reality is, if you just compounded that action over time of consistent investing, your results far outweigh those that are trying to just end up somewhere where they want to be uber successful without taking the risks. So there's always an element of risk, but that's actually the most recent advice that I learned that I think was good. Okay. Now, a fun question for you, Mark, is do you think you are a cautious or risky investor? And elaborate a little bit for us as well.
Yeah, easy question. So when I was younger, if we go back 10 years ago, very risky. And that's when you should be. Let's not beat around the bush. You get older, you have more on the table to lose. Okay. And, you still need to be diligent with whatever you do, whether it's, risk adverse or risk taking. But, a good example is even business. I think business is a major risk that a lot of people don't take because there's so much uncertainty more than anything. Real estate, there's a lot of uncertainty in certain parts, but majority of it is certainty, all right? Same with investing into blue chip stocks, whatever it may be.
Yeah.
Personally speaking, I have probably gone too far in being very risky when it comes to investing, but at the same time,
give us like a small taste of it.
Oh well, look, I think I've put money into ventures that have they've done really well now, but when I exited at the time, they didn't pay off. So that was in business. Walked away with a bit of a loss, to say the least.
Yep.
We won't go into the numbers side of things. It was something where, without going in detail, of course, if we look at it now, we can see that I probably exited at a loss of, let's say, $1, and now that company turnover is now at about $10 or $20. If that puts it into perspective, right?
Yep,
so it's something that, from time to time, it can kick you up the arse a little bit and make you feel a little bit sorry for yourself, but we've moved on. It's done and dusted. When you get family, I think that also gives you a little bit more element of adversity when it comes to risk, because again, you're not putting your life on the line. See, I didn't care before because it was me, and if I lose, then guess what? If I have to start again, I've got to know how to do it.
Right.
But my son doesn't, for example. All right. So that's something where you've got to be mindful of those things. And I think, you have to be less selfish, if that makes sense. But at the same time, if it's a burning desire within, don't curb it either.
That's so true.
Go. That's what I believe in anyway.
And having no regrets is something that we can probably proudly say, looking back. I mean, there's obviously things that you'd rather have done better in life in general. But investors having regrets is what I feel really bad about, where you could have had that burning desire to, take an action, have a crack, as we say in Australia, and then...
Well, it's funny, Sean. My mum used to always say, I love my mum, but she'd always say, if you're going to be on your deathbed, you're going to put in so much effort into this business, blah, blah, blah. Your family's not going to say to you, or you're not going to say to yourself, sorry, she used to say, I wish I had worked more. And I'm like, yeah, all right. But, what about the family that you're providing for if you take that risk for them, right? Using them as the excuse, right? Yeah. So,
or imagine at the funeral, right? You leave them with $1 to your name, but you gave them all the time. And they're going to be sort of upset that you passed away because there's not really much there. But imagine if you left them behind a fortune. That funeral would be quite a party.
Makes a big difference.
Makes a difference. I mean, to some circles, obviously not to every circle, but yeah. Anyway, I think you got a curveball for me right now. So let's.
I do. I like to throw these ones. So, in regards to rates and return on investment, things like that, Sean, what is an expectation on your end in regards to your rate of return within an investment?
4.5%.
Easily put.
Yeah. That's my expectation on my investment return. 4.5%, because the markets that I help my clients invest in for investment growth in property tend to perform at 8.5 to 9.5%. So go half of that, you're looking at around 4.5.
Yep.
And for me personally, the stocks that I invest in have a historic track record of providing that 7 to 9% return as well. Go roughly half of that, 4.5%. It's not worth, I think, placing your dreams or your bets or your investment strategy on a hope and then hoping that it does what it always does. I tell all my clients that I work with and have worked with for the past few years, if the worst case return was a number, what would you attribute that number to? And for me, it'd be 4.5%, because you're still smashing inflation long term as well. So
I was about to say that as well. Like, even if you're looking at look at inflation rates spread out over those 20 years, let's say, in the 20 years to come. I mean, even if they do increase, let's say on average by another percent, what does the RBA want to do? They want to curb it at 2 to 3%. So even if they start curbing it at 3 to 4, makes sense.
Spot on. Awesome. Now, a little fun question for you, and something that might give the audience a little bit of an edge into the real Mark Vittori behind the scenes over there. So, does your family, from anywhere, any sense of the word family, does your family have any sort of history when it comes to investments in general?
Good question. So long story short, love my dad. He's a bean counter. So he's an accountant by trade. So he's very risk adverse, to say the least. But he has been investing in real estate and stocks as well, for that matter, for a very long time. He probably went through a little bit of a period a couple of years ago now, where he wanted to get a little bit more advantageous, because I think life had thrown him a bit of a curveball that he looked at and goes, wow, is this all it's meant to be, and get kicked to the curb essentially.
Right.
But look, not really. Even if I look at my greater extended family, not really. I personally would think that I am probably the black sheep of the family, and I take pride in that as well, to be honest. And it's something that I've been a big believer of, and I've done a lot of research on it, where you'll find there's a lot of let's say business owners, their children follow in footsteps of fathers and mothers.
Oh, well, you'd hope so,
You
right?
would hope so,
and
right?
it's
And
tragic when we see situations where it doesn't happen.
Well,
like we do have a
yes.
few guys on our books that
Yep.
don't have necessarily sons and daughters that follow their footsteps. Although, like I remember last Friday night when we were doing Friday Night Live, we had run into this quite wealthy individual who had a daughter and a son, and I think the daughter was just headhunting his business to a whole nother level. He in fact showed us an email from his daughter that day talking about investment performance and the company's gross turnover, and we were just so happy for him from our hearts.
No, I
But
agree,
not always
I
the
agree.
case, right?
No, it's not, and unfortunately, we were talking about this as well. Actually, you're right. Where some people obviously they're not made for it either. Unfortunately, but no, there's history of investing, yes, but no history of big bold risk taking, if that makes sense. Yeah.
Oh, fantastic.
I wanted to understand as well, Sean, on your end, how far do you trust people with your money? I think this will give a bit of insight as well about the real Sean.
Okay. I'm only laughing so much. It's not a cynical. It's not like a scary, cynical thing. Okay. I'm laughing so much only because I need to wear two caps on this one. Okay. Genuinely need to wear two caps. Trusting people with my personal money, and when I say personal money, I have a very split mentality when it comes to business, aka JR Group, JR Prosperity, and I have a very separate mentality, as you know, when it comes to the persona of a Sean Floyd Pereira. Sean will overpay for mechanics, overpay for tires, overpay for watches, whatever it is, all the time, and overpay for a lifestyle above and beyond anything. If I'm going out and if it's a matter of not double checking the invoice, I never check.
I can attest to this. He speaks the truth.
You and I are both generous blokes, and on a personal front, for me, it's I don't look twice. I'm very loose. I play loose. I play fast, and I enjoy that personality trait in me. It's one of the downfalls of my star sign. I'm very trusting on the outside. However, what I have learnt over a number of years is when it comes to business, when it comes to clients' money, when it comes to the business cap side of things, I am the number one shark in town. So trusting is not something that you do. Trust needs to be earned. Trust needs to be proven in a business landscape. So I'm very smart when it comes to managing business affairs, so much to the point where I even don't give myself access to a whole bunch of things. I pass it off to our CFO, pass it off to our accountants. So I'm very proud that over the years I've learnt to wear two caps to Sean. There's Sean the businessman, and then there's Sean who's just happy for everyone, happy-go-lucky, and wouldn't look back twice. But business Sean's very, very different.
Funny you say that as well, Sean. Just quickly on that topic, the book, there is a book about it, but I watched a 30-minute clip on it explaining the Atomic Habits. I read it listened to it a while ago, and they mentioned it almost in reverse, saying be very frugal with personal spendings, let's say, but be very fruitful with business, because obviously business pays. And I think what they were trying to get at was buy the new suit. All right, don't do it because you're going, I'm indulging and I need to wear a new suit. Do it because you know that new suit's going to make you look good, which is going to get new business, blah, blah, blah. And it's interesting you say that, because you do. I think people don't realise you do actually have to wear two hats, whether you are in business or not. All right. You need to have that side of you that says, I'm going to just give everything because it will give me a return times 10, whether it's my family loving me or whatever it may be. Well put.
No, that's good. Thank you. A lot of people, I've actually never been asked that question before. So I loved getting that question. That was really nice. Cool. So speaking of questions, what question would you, Mark, personally like to ask an investment expert, not someone who proposes to be an investment expert, but someone who really is an investment expert in true sense of form. For example, a Buffett or someone really big. What would you like to ask them?
You know, that's a great question, and I think for some people they might have a very direct answer. Oh, what was the first thing you invested into? For me, I look at it very complex. Maybe that's just my brain, but I think it needs to be looked at that way as well, because you could ask a Warren Buffett as an example. What was your first investment? He'll give you whatever everyone else knows. But I want to know Warren Buffett in 2020. I want to know what's your investment advice during this collapsing time, or when we're in a different era completely, where there's new technologies and new this. So I think for me it's a bit of an open-ended question where there's not a direct exact answer. It's more about it all is relevant to the time that we're in, because that investor, a Grant Cardone as an example, he talks a big game, Uncle G. I think we love him in certain parts and hate him in others.
His personality.
Love him, right? I can't fault him, but you then hear these other conflicting stories, and we don't care because everyone has those conflicting stories. Yes. It's just the fact that what he did 20 years ago is going to be pretty different to what he's doing today. Where's his investment going towards today?
So right, I was watching an interview with Ryan Serhant the other day, and he said, "What got you here won't get you there." That was amazing.
That's pretty cool.
What got you here won't get you there. And then thinking of that in terms of what you said about, there's a philosophy, there's changing times. I suppose the only constant we always have is change. So how do those experts maybe change at a time where you've never had this market situation ever before? We talk about things, just you and I, Mark, on a daily basis, about the rapid rate of business changing as well, which means that if wealth is being lost fast, but it's also being accumulated fast as well, which means that there might be opportunities for a market depression to not last 36 months. It might only last 12, for example. But very, very interesting.
Another thing I wanted to actually ask you, Sean, was how confident are you investing your own money?
I'm actually 110% confident in investing my own money. 110%. I don't. Fortunately, I'm at the position where I don't pass it off to money managers and deal makers so far. It'll be quite stupid if I'm promoting myself as a director of a investment firm and then I'm sort of just palming it off to someone else. Although that's not a stupid thing as well, because it's all about time. If you have the time for it, should you do it, so forth, so on. For me, luckily, because the portfolio is quite simple, real estate, basic stocks, no giant risks. I do take risks, but I don't take risks where they can't be backed up. For example, if you want to buy a car, which I love cars, you want to buy a nice car, you make sure that having that car won't impact your lifestyle for 24 months. And if that means, you're having the repayments and an emergency account for that car locked away for 24 months, you're not going to be stressed every single day that you own the vehicle. Same thing goes with investment property. So if I'm going to take a risk on it, it's so funny you asked this question, because how confident am I investing my money? I asked my banker a question over last weekend that just passed. And I asked them going, hey, I want to do this next year, delayed settlement. I don't have to worry about the financials this year and so forth, so on, la-di-da-da-da. And they came back with this heavy analytical argument of going, no, Sean, don't do it. And in my mind, I'm like, great. So if I have X, Y, Z, can I do it? And they go, yeah. I go, great. That's all I need to know. And I will do me. So extremely confident, taking calculated risks, I would say. Life is a game of risk, right? Everything's risk. So if you can calculate it well and not spend, like we joke about it sometimes, 7 months calculating risk, you'll be fine.
On the back of what you're saying as well, I think it's very important. Like, you're confident with investing your own money, right? Mainly because of the fact that, yes, you are in the industry pretty much day in, day out anyway, right? But there are a lot of people that are outside of the industry, let's say, whether it be real estate or stocks or financial planning, whatever it is, right? I guess some advice, at least from our end to those listening that aren't in the space like we are. Find someone you can trust, right? Take a year to find the right people if you really have to. The planning shouldn't take long, but the trust building, I agree, should probably take a bit longer than usual. And, understand what people's motives are, things like that, where, not necessarily where they get paid, but, how long are they there for you, right? Because, I mean, if you weigh up us in real estate, well, we are here at least for 10 years, depending on how much real estate you want to buy. At a minimum, I look at it for 10
as
years.
an
At a
offering
minimum.
for them,
Correct.
because we have already been here for 12.
That's right.
Actually,
That's right.
sorry, not 12. We celebrated our. This is so funny, but maybe a little hooray announcement, Paulina. If you can add a little woohoo and some celebratories in there, that'd be great. Producer Ryan, let's put some champagnes in the air, because this month we celebrated our 13th birthday. We're officially a teenager. I think this year, right? Was it 12? 13 this month. Producer. 13?
Yeah.
Sorry, it's 12. Sorry, my bad. I forgot.
12, yeah.
We're going to be a teenager next year, but it is our 12th birthday.
This is not financial advice.
But yeah, so having those track record in the game, skin in the game, like you say.
Correct. You ask the questions, sit down with them, get to know them, and that's it. And I think that should then help you to then invest your money correctly, because again, at the end of the day, someone that says to me, I don't know what to do, and I say, well, I can't ask you to trust me, but I can certainly show you where your money is going to work, how it's going to work, and if the market goes belly up, well, guess what? We've done everything on a worst case scenario anyway, so you're in good hands in that regard. So, yeah. That's my input there, but
Wonderful.
I think it's very important to know if you don't know what to do with your money, because a lot of people don't. Let's be real, find someone you can trust.
Absolutely. And I think that sort of brings us to almost the end of what was a very, very fun introduction to Investment World 101 or Investment 101, which is good. I love this format. This was really fun. Collating questions from sometimes the office and the wider audience out there, and then just blasting them to each other and getting everyone from the outside to see a little bit of what's inside, this glorious abode we call the JR Group. So I'm very excited to keep it going. Now, in traditional fashion, because we wanted to keep today very short and very sharp, it's time for rapid round robins. And the answer has to be delivered insanely quick. Mark, are you ready for this one? Drum roll, please. What is your favourite colour of tie?
Red. Yours?
Red.
There you go.
There you go.
And that's
ladies
another
and
week
gentlemen,
of Friday Night Live.
it is indeed. It's been a pleasure.